We were trimming in January. We're not really selling now. Prices down, valuations down, sentiment weak. I mean, that is just the perfect setup for a strong move.
Special coverage from the floor of the World Symposium is brought to you by Palisades Gold. Adrian Day joins us here at the World Symposium. He is the president of Adrian Day Asset Management and the portfolio manager of the Euro-Pacific Gold Fund. Adrian, welcome back to the show.
Oh, good to see you again, David.
Good to see you in person. We had you on over Zoom just a few weeks ago. It's always better in person, I feel like.
Always.
How are you evaluating the sentiment here at the World Symposium right now versus a few months ago when we talked at the Vancouver show, I guess?
Yeah.
Also at Beaver Creek.
No, I think the sentiment is definitely positive. I mean, remember, these are gold investors. So these are people, by and large, who've been invested in gold a while. They've made some money in the last few years. No, I would say the sentiment is quite bullish, but I would call it realistic.
How many people are concerned about the pullback from 5,000?
Exactly.
If they're long-term holders, why do they care?
Oh, I don't think they're concerned about the pullback. Yeah. There is a concern, are we going to see another pullback? You know, if gold breaks down, let's say gold retests for a recent low and fails on that retest, amid all the hawkish talk about interest rate hikes, if we fail on that retest, you know, we'll be down to 3,600.
Yeah.
Not the end of the world, but the stocks, of course, will come down meaningfully from that. So there's not a lot of concern about what they've lost already from 5,500, but I would say there is more concern about the possibility of another pullback.
And they're probably concerned also about the possibility of higher interest rates, which may affect the dollar positively, and gold doesn't like a stronger interest rate or a stronger dollar.
Well, exactly. At the moment, we've got the worst trifecta. We've got a higher dollar, or we've got higher CPI, which means, you know, the potential for higher interest rates, and of course bond yields. The bond market's already done what the Fed hasn't yet done. The yields are up. So you've got higher yields, higher dollar, and the potential for higher interest rates. You know, that's negative. That's negative for gold. Now, let's not forget two things. One is we still have negative real interest rates. Yeah. You look at the CPI, which understates inflation, but forget that. You look at the CPI and you look at the bond yield, and we have negative real interest rates. And the other thing, we're talking about the Fed, you know, it's obviously the sentiment right now is that the Fed is going to raise rates. You look at the Fed funds futures, you know, over 80% in January were saying rate cuts this year, so with a plural. And by April, 80% were looking for rate hikes this year and next. So the sentiment swung dramatically, and the gold price reflected that. Part of the sentiment for higher interest rates, of course, is Kevin Warsh coming in, and the hawkish tone was backed up by the higher CPI, right, and the strong jobs report, remember? So both of those two things were saying, oh, they can and maybe should raise rates. What have we seen since then? Well, the last jobs numbers we had were pretty pitiful. And not only was the latest month pitiful, but they revised downwards, you know, the previous strong number. Yeah. So that's one thing. And with the oil price coming down, you know, we know that one of the reasons that the CPI rose so much in April and May was because of the higher oil price. Well, with the oil price having come down, that should feed its way through to gasoline prices. So we should see a lower CPI number, I think only temporarily. It always takes longer for a lower price to feed through to the gasoline pump than a higher price. You know that, right? When the price of oil moves up sharply, it's reflected in the gas prices very quickly, very soon, but it takes 6-8 weeks before it feeds through on the downside. So you've got a situation where the job situation now, by government-owned numbers, doesn't look as good as it did a month ago. And the CPI number could be weak for July and August. And so I think a lot of the pressure on the Fed to raise rates will perhaps be removed. That was a long answer, but I'm sorry.
Following on the same train of thought, economic growth has been quite robust in Q1.
Yep.
Revised up to 2.1%. I'm talking about Q1 GDP. That's a sharp move upward from 0.5% in just the prior quarter in Q4 2025. Does this stronger economic growth number indicate to you that perhaps not all oil spikes lead to a recession? Maybe this time is different?
Well, I'm not going to say this time is different. Four most dangerous words in the investment lexicon. I mean, I certainly think, yeah, the economy's been more resilient than I thought it would.
Yeah.
And there is an awful lot of, there's a lot of cushion in the economy right now. And so the higher oil price, and of course oil prices are nearly back down to where they were in January. They're already back down below they were when the war started.
Right.
But if we get a higher oil prices, remember that doesn't affect the U.S. as much as it did, in the 1974 oil embargo, or in the 1990 invasion of Iraq, or in other oil price spikes. Previous oil price spikes, which led to U.S. recessions, were when the U.S. was a net importer. Now we're now in oil self-sufficient. So the impact of a higher oil price will have less impact. But I frankly think we'll have to wait and see. If oil shoots back up to 120 and then up to 150, I think that may still lead to a recession. But we'll see. But certainly the economy at the moment is much more resilient than I thought. There's a lot of cushion in the economy. So I think it can certainly withstand higher oil prices.
Before we continue with the video, let me tell you about one of the most important problems of owning gold. So gold has been a store of value for thousands of years, for as long as people can remember, but it doesn't generate an income unlike many other assets. That's a problem. But that's also where today's sponsor, Monetary Metals, comes in. Monetary Metals offers investors a way to earn yield on their gold paid in physical gold. Through its leasing platform, investors can earn up to around 4% annually, with yield paid monthly in ounces rather than dollars. That means your return is measured in gold itself. The gold remains your asset and can be redeemed at any time. Thousands of investors are already earning a monthly yield in gold through Monetary Metals. Visit monetary-metals.com/Lin, link down below, or scan the QR code here to learn more and get started. And you can start earning a real yield in gold today. Yeah. Caution aside, I'm talking about caution with the gold price itself. Are you cautionary on the gold mining space? With the GDX fallen 35%, is this a good buying opportunity?
Well, yes and yes. Am I cautious? Is it a buying opportunity? Yeah. Yes. If gold breaks down, as I think it might, is it a 20% possibility? I don't know. But if it does go, when I say break down, I'm sorry. If it breaks under the previous support level, the previous low, obviously the gold stocks will come down lower. But if you look at the gold stocks on a price basis, as you said, 35% down from January. On a valuation basis, valuations within the lowest 20 percentile of historic valuations. You look at anything you care to look at. There was a report out by Scotia recently, which looked at the gold stocks, maybe 20 of the producers, and they looked at them on the basis of all different valuations, on valuation metrics. And on virtually every single one, the space is within its lowest quartile today. So the valuations are low, and the sentiment, David, is extraordinarily low. We are still getting withdrawals from the GDX. People are not taking advantage of the low. And as you know, the bull-bear sentiment index is hovering around 7 to 7.5% bullish on gold equity miners, which is in any bull-bear sentiment index. They do this for stocks, for the dollar, for different assets. But on any bull-bear sentiment index, to be down at 7% is very, 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 very weak. I mean, it's an extraordinarily low number for any market at any time. But one day, 2 weeks ago, we actually had 0 bulls in their sample. We had a 0 bullish sentiment. So the sentiment is just about as weak as it could possibly be. So prices down, valuations down, sentiment weak. I mean, that is just the perfect setup for a strong move. And so what we're doing, frankly, I mean, if we've got a conservative global account who opened 3 years ago and we had a 20% gold allocation for him, and we've sold a little bit on the way up, but that allocation, he now owns 35% in gold. I do not feel the need to buy any more for that client. If we have a client that opened in January and I bought a little bit but was nervous about going all in, we are definitely buying more now. Definitely.
Market moves aside, I'm talking about the underlying metals, gold, silver. Market moves aside, what have been the most frustrating hurdles for your particular investments to move up? I'm talking about company-specific events or milestones that you would have wanted to see as an investor that maybe didn't happen in the last couple of years. Was there a trend?
No, I don't think so. I think we always tend to be more optimistic and eager for M&A to happen. Yeah. And M&A takes a long time, especially if it's senior companies involved, because as I think we've talked before, but people need to realize that senior companies, if they want to buy a junior, they're less interested in buying when the price is low than they are buying when the junior has already de-risked the property, when they have the social license, when they have their permits in place, when they've already got a resource. So the senior is willing to pay up for a de-risk project. And the other thing that's really critical that people don't always focus on is, unless it's an asset where you're going to get keen competition, a competitive process like the Rupert in Finland, clearly there was more than one company interested. But unless you're going to see that competitive tension, the senior company is going to want to buy when it fits into their pipeline. So again, they are willing to pay up. And so, when you see an M&A activity that you say, this is just obvious. This is obvious. It's obvious that company A is going to buy it. Why don't they just buy it? We're surrounded. Our property's surrounded by them. Well, they can take their time. They are in no hurry to buy it. So that's a bit of a frustration sometimes. But for me, honestly, David, I wish I had a good answer for you, because you asked what's frustrating to me. We very, very rarely will we buy a stock purely because we think it's going to get taken over. We buy a company because we like it, because we think it's good value, and a potential acquisition is just icing on a cake.
People talk about management teams as being an important criteria for selecting a mining company, but how important is a management team when it comes to building a takeover target? In other words, if you have a deposit, does it really matter if your management team has a track record of building a mine?
Bad management can always screw up. Yeah. They can drill in the wrong... Sorry, is that... Yeah, I guess I can say that.
That's okay.
They can always, they can always drill in the wrong place. They can have a bad, they don't have the right thesis on the project. They can mess up the community relations, so they don't have the social license. Yeah. They can waste money and dilute and continually raise money and dilute. No, there's a lot of ways a bad management can screw up a good project. Absolutely. And so when you are taken over, maybe you bought the stock at $1 when there are 1 million shares, 10 million shares out. It's taken over when there's 100 million shares out. Well, it's still at $1. So yeah. I would always take good management with no money and no project over bad management with lots of money and a good project. Always.
Are you selling any of your stocks right now, your holdings? Are you planning to unload some positions after a great run in the last year?
Well, look, to be honest, we were selling in January, particularly the silver stocks, which went exponential. So we were trimming accounts in January. never as much as you would have liked when you look back, but we were trimming in January, but particularly the silver stocks have moved up so far. We were selling again in April. So no, we're not really selling now. I would want something to change, either prices to move up or something fundamental at the company to change.
Okay. Any significant headwinds you see on the horizon for gold and the precious metals? We've talked about risks, downside risks a lot. What about the other way around?
Headwinds, sorry. Headwinds, though.
Oh, I'm sorry. I meant tailwinds.
Sorry.
We talked about headwinds. Yes. I meant tailwinds.
I think a big headwind potentially
Tailwind.
Tailwind, sorry.
I got you. I got us both confused. It's my fault. Yeah. Any upside potential for the
I mean, definitely. We see the Iran situation resolved, and we see the dollar start to go back down against other fiat currencies. That would be a huge tailwind for gold. If we start seeing talk from Kevin Warsh, and I always hate to put too much on, one government individual, because the Fed is government, whatever they say. But, but if we see, I think there's a possibility of a meaningful revaluation in the gold price, over the next few years. But if we start to see people talk about that, how gold is going to play a role in the monetary system, that would be hugely significant for gold, and an unexpected tailwind.
Right. Does gold need higher inflation now to go up?
No, gold does not need higher inflation. Higher inflation and and lower real interest rates, which are a sort of corollary, that would be very important for getting retail people back into gold. But if you look at the main buyers of gold over the last 3 years, the main buyers that have driven gold, the central banks, and then more recently Tether, they are not looking for higher inflation or lower interest rates or anything else. They are buying for very specific reasons and price insensitive. They are price insensitive. So, yeah.
Yeah, explain.
Well, I was just going to say, so a central bank is buying, well, first of all, they're selling dollar. That's where it starts. Central banks are selling an asset because they're nervous of concentration in an asset that is an asset of a fiscally irresponsible government that is willing to weaponize its dominance. And so that has been going on for 15 years now, picked up dramatically with the confiscation of Russian assets after the invasion of Ukraine, and nothing that the current administration has done has changed that thesis. But the important thing to realize, a really important thing to get across, central banks' concern about a concentration in the dollar, which is the asset of a fiscally irresponsible government which is willing to weaponize its dominance, did not start when President Trump was sworn in, and it will not end when President Trump's term in office ends. It's something that transcends that. So we're going to continue to see that move. And the central banks reduce their dollar exposure for one asset that they've been buying, and the one asset that makes sense for them to buy is gold, because gold is an asset that's no one else's liability. It's the only asset that's no one else's liability. So if you're concerned about a weaponization, you want an asset that no one else can take from you. So Russia owns gold in its vaults in Moscow. Short of, well, this doesn't sound very good. I was going to say, short of a nuclear bomb going off, that gold is safe. It's in their own vaults. No one can touch it.
I guess partly answers my next question as to why central banks are interested in holding gold in their FX reserves anyway. Presumably, if you're doing trade with multiple trading partners around the world, you would hold a reserve of their currency such that you can do trade them. People don't really trade in gold that much. So
Correct. No, they're holding gold as a reserve, not for trading, but as a reserve asset. Because of what I just said, it's two things. It's an asset that holds its value.
Sure.
And it's an asset that's no one else's liability, so it can't be confiscated. And let's not forget, prior to the huge dominance of the dollar in central bank reserves, 1999, the dollar was like 80%, 78% of aggregate central bank reserves. It was huge, but prior to that period, you go back to the 60s and 70s and 80s, beginning of the 80s, gold was the dominant asset. So the central banks are really only returning to their traditional primary reserve asset. They're only returning to that.
Let's talk about some of the changes in 2026, in the later half of 2026, that you might anticipate versus the first half. With the economy,
crystal ball.
There you go. Yes, please do. And basically changes in investment themes or trends. We now have two, I guess, if I may, two developments that I'd like you to comment on. First of all, the coming of Kevin Warsh, whom I don't think we've talked about in too much detail last time. And second, the unwinding or normalization, shall we say, of the Iran situation.
Yeah, well, look, as you say, looking at the second, I'll answer those two, but looking at the second half, most of these significant trends I see are already underway. You said Kevin Warsh, you said Iran. The other thing, let's not forget, is the collapse, if you want, or the unwinding of the AI bubble that we're seeing. And also the potential for private credit. You know, I don't think the risk in the private credit market has gone away by any means. And I will remind people who were concerned a year ago, but their concerns have been assuaged because nothing has happened since. Right. Let's not forget from the blow up of Century, what was the name of that mortgage company that blew up in 2007? What?
Fannie Mae?
No. Century, was it? There was a mortgage company that blew up, and everybody said, "Oh, housing bubble's about to burst." It was a whole year before we had Bear Stearns and then Lehman. So, and then so what I'm saying is that was a whole year, and so the fact that we haven't had a credit blow up of significance in the last year does not mean that market is not a risk. So I think those are four very, very meaningful things. The Iran situation is really just if that gets solved, that really just sort of, from the point of view of the markets, takes us back to where we were before it started. So I wouldn't call that a hugely fundamental or long-term fundamental shift in markets. The biggest concern to me, or the biggest market effect, would be that countries that found themselves suddenly squeezed for oil, not that the price went up, but that they couldn't get it, mostly in Asia, those countries are going to be more willing. They're going to see building an oil reserve as a priority and an urgency, which they didn't before. So, and that applies to most of Asia. We don't know if China had reserves or not, but that applies to China. Japan had reserves. We know Japan, but other than China, which is a question mark, Japan was the only country in Asia that had built up meaningful reserves. So I think all of those countries are going to build up reserves of oil, and that, of course, means more demand and higher prices.
After witnessing the events of the Iran war, it's been more than 130 days now, Adrian. Have you, as an investor, thought about a next potential choke point and the associated asset of that choke point? In other words, another Strait of Hormuz kind of incident that may push a commodity in one way or another.
Yeah, not really. I mean, there are obviously potential choke points, but nothing. I mean, the Straits of Gibraltar coming out of the Mediterranean, or obviously the Dardanelles coming out of the Black Sea, which is Russia's way to
perhaps financial or geopolitical choke points as well.
Yeah. No, not really. Nothing that's imminent. I mean, I do think that private credit is still a risk.
How is private credit a risk? Can you just expand on that a little bit?
Well, because the private companies mark their own loans. So I give you a loan, I mark it at 100 cents on the dollar. My performance fee is based on the valuations of my loans.
Yes.
I have a incentive to continue to value it at 100 cents on the dollar. And it's a private loan, so no one can really see it. And it's a private company that owns all these loans, so there's no scrutiny. And so I can value it at 100 cents on the dollar until I clearly can't anymore. So let me give you an example. When a company values a loan at 100 cents on the dollar for this month, for this month, for this month, and this month, and then the next month they value it at zero, I would say the odds are remarkably, remarkably high, but they were overvaluing it for the last few months. Because a private company with a loan doesn't typically just go from very healthy and able to pay back the loan to bankrupt to not able to pay back the loan. So they should have been marking those loans down. That's a very obvious sign to me. And remember, these things are done on leverage. So I think there's still a risk in the private credit market, and if interest rates were to go up, that of course only makes it more, that only makes it more likely to happen. The AI stocks, I think, are just grossly overvalued based on future earnings, but may or may not come. A lot of the companies that are building these huge data centers do not have models for how they are going to make money from those data centers. That is just astonishing. So you're putting millions, tens of millions, and billions of dollars into building data centers, along with half the world, it seems, also building data centers, and you don't have a plan. And we know that we need energy and silver and copper, to build and to power these data centers. Resources that simply are not there to supply all of the projected data centers. So we're going to get that scale back, and that's going to affect the prices of, the companies that are, building the data centers, where it's a major part of their business. So we've already started to see, you look in NVIDIA or Microsoft or Amazon, all these companies, their stock prices have come down 15 to 20% over the last month. Yeah. So they are coming down, while the broad market, the broad market over the last month is essentially flat. I don't know what it's doing today, I'm sorry. But while the broad market is essentially flat, those erstwhile leaders have come down meaningfully. Yeah. So that's a sign that those stocks are under pressure. I think we're going to continue to see that. And as for David Warsh, I'm not a fan of the Fed. I don't know if you know that, or your listeners know that. I'm not a fan of the Fed as an institution. I'm also not a fan of the last three governors in particular, but also Greenspan, frankly. But I'm not a fan of what the Fed's done in the last 30, 40 years. But Warsh struck me, and I don't think I'm being naive, although I'm willing to change my mind in a few months, but Warsh struck me as someone who has an understanding of the markets. That's really important. Remember, Yellen and Bernanke had never worked a day in their lives in the private sector. They've never had to meet payroll. I mean, how can you pretend to run the Federal Reserve when you've never had a private sector job? You've been a professor or an economist all your life. And I ask that seriously. So those two had never worked a day in the private sector in their lives. Powell was part of a hedge fund or money management firm, but anyway. But So Warsh has an understanding of markets and how they operate. I think that is key. Warsh has an appreciation of the problems of the Fed. And in his press conference, he alluded to, he didn't go into it, he didn't attack the Fed, but he alluded to several of those problems. I mean, one he talked about was the backward-looking data. How by the time the Federal Reserve gets economic data on which they are basing their decisions, that data is already out of date. And I don't mean it's out of date, because we had an Iran war we didn't know was coming, but even in a normal economy, you think of employment data. You get the employment data, which is 2 weeks after the end of a month that they're reporting. Then you have the first revision, then you have the second revision. That data is 3 months out of date before we have a good idea of what the data actually is. But the Federal Reserve is basing their decisions on that data. He understands how that is idiotic, and he understands that we can collect data nowadays in different ways. We should be. He also alluded to, I've made the facetious comment that some of the 100 or 200 PhD economists in the Eccles building would be better served just getting on the phone and listening to corporate conference calls. Just get on the call and listen to what the companies are saying about individual businesses. Because when FedEx is saying their revenue's down because there's fewer packages, this is hypothetical, sorry, that's telling you something in real time about the economy. And they have a good expectation of whether that's going to continue in the next month or 2 or 3. And so I've said that before, just haven't listened to conference calls. He alluded to that in his press conference. And he talked how we should be listening to companies and what they're saying, and what the Fed should be doing, instead of what he would like to see is companies the stock market react to what companies are saying, rather than the stock market react to what the Fed's interpretation of what old economic data is saying.
Final question. If they were to make those kinds of phone calls, what do you think they'd hear right now? There's a confluence of economic data we can point to potentially answer that question. But for the most part, I would argue consumer resilience is quite strong still. Retail sales are up. Sentiment slightly ticked up.
Yeah, what they're hearing now is very mixed. Certainly in terms of sales, in terms of consumer, they're hearing a very strong economy and a continuing resilience.
Right.
They're also hearing higher prices and suppliers. Remember, a CEO will tell you, our suppliers have told us they are going to raise rates in the next few months, right? I remember, so they're going to tell you what their suppliers are telling you. That's forward-looking information. That's not backward information. So they're hearing that the consumer's resilient, but they're hearing the price inputs are going up. And I think they're hearing that employment is not as robust as we think. When you have a low number of people leaving jobs voluntarily, that's not a healthy sign. That's a sign that people are concerned that if they leave their job, they may not be able to find another one. That's a weak sign. So I think it's a mixed picture they're hearing right now.
Okay, excellent. Appreciate your talk as always, Adrian. Thank you so much. Where do we learn more from you?
Well, Adrian Day Asset Management. .com. AdrianDayAssetManagement.com.
AdrianDayAssetManagement.com. We'll put the link down below. Make sure to follow Adrian there. Thank you very much, Adrian.
Well, thank you so much.
A pleasure to speak with you as always, even better in person. So I look forward to next time. And thank you for watching. Don't forget to like, subscribe.